Order blocks are special candlesticks that start big price moves. They are not just any candles, they're the ones big market players use to kick off trends. When you see a big market move, it didn't just happen by chance. It started somewhere. And that starting point is an order block. It's where the big players, the market makers, set up and get ready to push the price around. Order blocks form because of liquidity. The big players need a lot of liquidity to make their moves. And when they can't find enough liquidity to fill their orders, they make it themselves. They do this by opening positions in both directions, creating fake counter liquidity. This lets them fill up the volume they need and then push the price where they want it to go. There are two main types of order blocks you need to know about. Bullish order blocks, which show up when the price drops, then suddenly shoots up. And bearish order blocks, the price climbs up, then suddenly drops. Order blocks are like pressure points in the market. They're areas where the big players, the market makers, have put a lot of their orders. When the price comes back to these areas, there's a lot of potential energy waiting to be released. Think about it. When a big player wants to buy a lot of stock or currency, they can't just place one big order. That would spike the price and they'd end up paying way more than they want to. So instead, they break up their big order into smaller pieces. They might start by selling a little bit. This pushes the price down and scares some other traders into selling too. Now there's more supply in the market, which is exactly what the smart money wants. They can now start buying at these lower prices. This process creates our order block. The initial selling creates the block part, the area on the chart where a lot of orders were placed. And because this is where the smart money started their buying, we know they're likely to defend this area if the price comes back to it. That's why order blocks are so powerful to trade. You're not just guessing where the price might go. You're looking at where the big money has already shown its hand. This is why order blocks will help you place better trades. They give you a solid spot to put your own orders when you're entering a trade. This isn't just guesswork. It's based on where the big players are putting their money. You're not just picking random points. You're using levels that have real significance in the market. Now, here's the reality. Order blocks aren't magic bullets. They only work if you know how to spot real liquidity in the market. On their own, order blocks don't mean much. In fact, most of them break as soon as the price comes back to them. I'll explain later the secret to find the best areas, but for now, think about this. Why does the price bounce off these order blocks? Well, it's all about the big players' average price. If the price drops below a bullish order block or jumps above a bearish one, those big players start losing money. And trust me, they don't like losing money. So they push the price back. It's like they're protecting their turf. This is why you often see that price returns to an order block before continuing its main move. Remember this part. Order blocks are based on a lack of liquidity when smart money needs to open positions. The market makers aren't just reacting to the market. They're actively shaping it. They're creating the conditions they need to make their moves. Let's say we have a bullish order block. The price has gone up from this area, but now it's coming back down. As it approaches the order block, several things might happen. First, the big players who bought here before might buy again. They know this level worked before, so they're happy to add to their position. Second, traders who missed the first move up might see this as their second chance. They'll start buying, adding to the upward pressure. Also, traders who sold short after the first move up might start to get nervous. If the price bounces here, they'll be in trouble. Some of them might start buying to close their shorts, adding even more upward pressure. All of these factors combine to make the order block a strong support level. And if the price does bounce here, it confirms the strength of the order block. making it even more likely to work again in the future. Now let's break down the anatomy of an order block. We are looking for a specific shape here. For a bullish order block, we want to see a move down, then price shooting up. For a bearish order block, price climbs up, then suddenly drops. Now, we're not just looking at a basic reversal. We want the last push, the last candle before the big move. It's the final gasp of the old trend before the new one takes over. This is where the big players make their move. You're looking for the last candle before the reversal. In a bullish scenario, it's often the last red candle before a string of green ones. For bearish setups, it's the last green one before the red candles take over. So for a bullish order block, we are looking at a down candle, but not just any down candle. We want the lowest red candle in the sequence. For a bearish order block, it's the highest green candle. These are our signal flares. They tell us where the action is happening. Some traders use the mean threshold for identifying these zones. It's like the equator of order block. We draw it right through the middle, at the 50% level of the candle. It's like a discount premium zone for the order block. This is where we expect the price to behave itself. If price respects this level, it's a good sign our order block is legit. It's all about validation. A strong order block shouldn't see price dip below this midpoint for bullish blocks, or rise above it for bearish blocks. If it does, it might be telling us our block isn't as solid as we thought. For a bullish order block to be confirmed, we need to see a more recent candle trade through the high of our red candle marking the zone. For a bearish block, we need a candle to trade through the low of our highest green candle. And for a top-notch bullish order block, we don't want to see price trading below the midpoint of that candle. For a bearish block, we don't want price popping above the midpoint of the green candle. Now, let's zoom out a bit. Where do we find these order blocks? We need to look at the highs and lows of the market. These are the optimal reversal spots, the turning points where the smart money makes its move. Now let's talk about the mitigation of order blocks. Mitigation is just a fancy word for cleaning up leftover orders. After a big player has bought what they wanted, the price often swings back to the order block. That's because that's where those initial orders are sitting. The big player wants to close them out, ideally at break-even. This back and forth creates the swings we see in the market. It's like a dance. Buy and then sell. Create an order block, then mitigate it. So how can you use this info? Well, it gives you a roadmap of sorts. When you spot an order block, you can expect price to come back to it at some point. That's your chance to hop on the ride. If you see a bullish order block, you're looking for buy opportunities. For bearish ones, you're thinking about selling. Remember, it's all about liquidity, or rather, the lack of it. When the market makers need to open a position, they often face a problem. There's not enough liquidity to fill their orders without moving the price too much. So they get creative. They open positions in both directions. It's like they're creating their own liquidity pool. They fill up the volume they need, then push the price where they want it to go. This is what creates our order block. When they do this, they are left with some positions that are now losing money. And like I said, big players don't like losing money. As us, retail traders, they want to close these positions at break-even. And the break-even point is right back at our order block. This is why price often comes back to test an order block. It's not random. It's the big money trying to clean up their positions. And for us smaller traders, this is an opportunity. Here's the difficult part. Not every order block gets hit, and some get blown right through. How do you know which ones to trust? It all comes down to liquidity. Liquidity is just a fancy word for where the money is. It's where a lot of buy or sell orders pile up. Often these are at old highs or lows. Big players love to target these spots because that's where they can find enough orders to fill their big positions. So when you're looking at order blocks, pay attention to nearby liquidity. If there's a juicy pool of orders just beyond the order block, chances are good that price will come back to hit it. This is part of the mitigation phase. Mitigation is when price swings back to the order block. Remember those leftover orders from the initial move. This is the time when smart money clean those up. They're closing out positions, getting back to even. For us, retail traders, this is opportunity knocking. When price swings back to an order block, it's often setting up for another move in the original direction. So if it was a bullish order block and price comes back down to it, that might be your chance to buy. Some may buy as soon as price touches the order block. Others wait for signs that the mitigation is done. Price action close, maybe a rejection candle, or a break of a small trend line. We'll talk about the best entries later. There's also a concept called a mitigation block. It's like a cousin to the order block. It's all about how price behaves afterwards. A mitigation block forms when the market fails to make a new high or low. It's a sign that the current move might be running out of steam. It's a failure swing. Here's how it plays out. Let's say the market's been going up. It hits a high, pulls back, then tries to push higher again. But this time, it can't quite reach the old high. That's a mitigation block. It's a hint that the uptrend might be in trouble. The opposite can happen in a downtrend. Price makes a low, bounces, then tries to go lower again. But it can't quite break the old low. That's a bullish mitigation block. It suggests the downtrend might be losing steam. Now don't confuse these with breaker blocks. A breaker actually does make a new high or low. It breaks the old level. A mitigation block falls short. And why does this matter? Well, it's all about understanding what the big players are up to. A mitigation block suggests they couldn't push price where they wanted. Maybe there wasn't enough liquidity, or maybe opposing players stepped in. For you, it's a heads up. If you see a mitigation block form, it might be time to start looking for a reversal. Now, before we continue, let us know in the comments what topics you'd like us to cover in future videos, and drop us a like to help us with YouTube algorithm. Order blocks fit into the bigger picture of market structure. Market structure shows the overall flow with its twists and turns. Order blocks are areas where the flow can suddenly change direction. In a bullish market, you'll see a series of higher highs and higher lows. And each swing up is usually kicked off by a bullish order block. These blocks are like stepping stones, marking the path of the uptrend. Now flip that for a bearish market. You've got lower lows and lower highs. Each drop often starts with a bearish order block. But here's where it gets interesting. Order blocks don't just go with the flow. They can signal when the flow is about to change. This is where market structure breaks come in. A market structure break happens when price busts through a key level. In an uptrend, it's when price makes a lower low. In a downtrend, it's a higher high. These breaks are big deals. They're like road signs telling you the trend might be changing. Now guess what often comes right before these breaks? That's right, order blocks. The market coils up at the order block, then a structure break follows. Here's how it might play out. Let's say we're in an uptrend. We've got those higher highs and higher lows. Then price forms a bearish order block. Price drops from there, and this time, it doesn't just make a higher low. It smashes right through the previous low. That's a structure break. This combo, order block plus structure break, is very powerful. It's telling you something big might be happening. The trend that's been chugging along might be running out of steam. When you spot an order block, don't just focus on that single level. Zoom out. Look at the bigger picture. Where is this block in relation to the overall trend? If it's going with the trend, it might be a continuation signal. Price could bounce off it and keep moving in the same direction. But if it's against the trend, it could be setting up for a reversal. If price respects the block and bounces, it could be a continuation of the current trend. But if it breaks through, especially with a strong move, watch out. That could be the start of a new trend. This is where those market structure breaks come in. If you see price break through a significant high or low after hitting an order block, that's a big deal. It's like the market is shouting at you that something's changing. Another setup to watch for is the failed order block. This is when price comes back to an order block but doesn't bounce off it like expected. Instead, it pushes right through. This can also be a tradable signal. Failed order blocks often lead to strong moves. That's because a lot of traders are caught on the wrong side. They were expecting the block to hold, and now they're scrambling to get out. This can fuel a big move in the opposite direction. A quick word on timeframes. Order blocks work on all timeframes, but they are most powerful on the higher ones. An hourly order block is usually more significant than a 5-minute one, but that doesn't mean you should ignore the lower timeframes. In fact, you can use multiple timeframes together. Find the big order blocks on the higher timeframes, then zoom in to the lower ones for more precise entries. It's like using a map and a GPS together. We'll talk about this later. High probability order blocks are followed by fair value gaps. These happen when price jumps from one level to another, leaving a gap. But unlike a regular gap, there's some trading activity in between. This imbalance signifies a sudden surge in buying or selling pressure, indicating the presence of institutional orders. These gaps show up as big candles on charts. The candles next to them don't touch fully. To spot a fair value gap, look at 3 candles in a row. In a bullish gap, the low of the third candle is above the high of the first. For a bearish gap, the high of the third candle is below the low of the first. These gaps aren't just random. They show where big players made moves. When a large order hits the market, it can cause a gap, and the market often wants to fill these gaps later. Both order blocks and fair value gaps are about imbalances in the market. When price jumps, it means one side, buyers or sellers, took control fast. This quick move can leave some trades unfilled. Fair value gaps are all about speed. When price moves too fast, it can leave these gaps behind, and the market wants to fill them. That's why they often act like magnets, pulling price back to them later. Order blocks and fair value gaps work well together. You'll often see a bullish order block, followed by a fair value gap. This is like a double confirmation of a key buy level. Or you might see price move away from a bearish order block, followed by a fair value gap. Later, when price comes back to fill that gap, it might also retest the order block. This could be a high probability setup. Also, don't forget about the bigger picture. Order blocks and fair value gaps are just parts of market structure. They fit into larger trends and patterns. Always keep the overall market direction in mind. The best order blocks have 3 key parts: a liquidity run, a break in market structure, and a fair value gap. Let's break this down. First, a liquidity run. This is when price moves fast to hit a bunch of orders. It's like a quick raid. Price shoots up or down, grabbing liquidity. This move often tricks traders. They think the trend will keep going, but it's just a setup for a reversal. Next, we have a break in market structure. This means the market's behavior changes. It could be a shift from an uptrend to a downtrend, or a continuation in the previous trend, or it might be a big move after a quiet period. This break shows something new is happening. A new high or a low must be formed from the order block. Last, the presence of a fair value gap. When you find all three of these conditions together, you've got a high-quality order block. It's like a perfect storm for trading. Let's say price has been going up for a while. Then it makes a quick spike higher. This spike might hit a bunch of stop losses above the market. That's our liquidity run. Right after this spike, price drops hard. It falls below recent lows. This is our break in market structure. The uptrend is now in question. As price falls, it leaves a fair value gap. Just below the order block, there's also a liquidity zone. This whole setup, the spike up, the drop down, the fair value gap, and the liquidity run, forms our order block. If price comes back to test it later, that's a decent short opportunity. The same for a bullish order block. It's all about reading the big player moves. The liquidity run is smart money pushing price to an extreme. They're shaking out weak hands. The break-in structure shows their true intent, and the gap shows how fast and strong their move was. These high-quality order blocks are rare. You won't see them every day, but when you do, they're worth paying attention to. Another signal. Price has been falling. Then it makes a quick drop lower. This might trigger a bunch of sell stops. There's our liquidity run. But right after, price jumps up hard. It breaks above recent highs. This is our change in market structure. The downtrend is now in doubt. As price moves up, it leaves a fair value gap. Above the order block, a potential liquidity zone. This makes it a spot to watch for future buy trades. Again, the liquidity run is smart money pushing price to extremes. The break-in structure is them showing their hand, and the gap shows the power of their move. Always consider the current market context when selecting your order blocks. Prioritize those that align with the prevailing trend direction and fall within the most recent price swing. In an uptrend, focus on bullish order blocks that form within the current upswing, rather than bearish order blocks from previous downswings. And when you find these high-quality blocks, it's best to wait. Wait for price to come back to the block. Then look for signs it's reacting. Maybe it stalls there, or it might make a small move and reverse. These are clues for potential trades. And please be realist. Not every order block will lead to a good trade. A successful order block strategy combines trend analysis, order block identification, and precise entry timing. First, you need to figure out which way the market is moving. You'll want to look at a bigger picture, so use a higher time frame chart. Let's say you pick the hourly chart. On this chart, you are looking for the current order flow, in this case, an uptrend. Now that you know which way the market is moving, it's time to find a good spot to enter your trade. The order block should match the overall trend. As the trend is up, look for a bullish order block. Before the order block forms, price should have taken out some liquidity. A bunch of stop losses, sitting just below a low point in an uptrend. If price dips down and triggers the stops before shooting back up, that's a liquidity run. Then the order block should trigger a break in market structure. This shows strength and commitment to the move. The size of the order block candle matters too. Generally, the bigger it is, the more significant it might be. It's like a bigger footprint. It shows that more traders were involved. Also, pay attention to how price reacts after the order block forms. If it moves away quickly and forms a fair value gap, even better. Remember, not every order block will lead to a good trade. Your job is to find the best opportunities, not to trade every signal you see. Another tip, look for order blocks that line up with other technical factors. Maybe it's at a key Fibonacci level, or it matches up with a trend line, or a moving average. The more reasons you have to believe in an order block, the better. Once you've spotted a promising order block on the higher time frame, it's time to zoom in for a closer look. This step is all about finding the perfect moment to enter your trade, timing your entry. So you switch to a lower time frame chart. If you were looking at an hourly chart before, you might zoom in to a 5-minute chart. This gives you a much more detailed view of price action. Your plan here is to wait for price to come back to your identified order block zone. First, check for realignment. This means the price action on your lower time frame should match up with the trend you saw on the higher time frame. As the bigger trend is up, you want to see bullish signs on the smaller time frame too. Look for a smaller version of the order block you found earlier. As you're in an uptrend, you're searching for a bullish order block on this lower time frame, an order block inside the bigger order block. You could also look for a small liquidity grab just before your entry. This is like a mini version of the liquidity run you saw on the bigger time frame. It might look like price dipping down to trigger some nearby stop losses before moving in your expected direction. Another tip to pinpoint your entry: look for any patterns forming on your lower time frame chart. If you see small double bottoms, that's a decent setup. Or maybe there's a small change of character. Price is breaking previous swing highs and it's ready to go higher. Remember, the goal here is to fine-tune your entry. You're not changing your overall view of the market. You're just trying to get the best possible entry price. The plan is to enter your trade on the breakout of the lower time frame order block. For this buy order, you place your stop loss just below a recent swing low. And please give it enough room to breathe. Don't try to be too precise with your stop. Your take profit should be ideally at least 3 times higher than your risk. But don't just pick a random number. Look at the chart and find the next logical high point within the higher time frame trend. And consider using multiple take profit levels. You could close half your position at your first target, then let the rest run to a higher target. Here's a pro tip. Order blocks must have a liquidity pool to target. Identify clear liquidity pools above your chosen order block. These pools act as magnets for price. They are like a roadmap for potential price movement after the order block is triggered. In this case, we see a bullish order block with a cluster of previous swing highs above it. This presents a clear liquidity pool that price is likely to target once the order block is triggered. Now, if you want to learn other smart money tactics, you need to watch one of these videos next.